Hi, good afternoon. It's Guangzi here. So today, we'll start our webinar now. Today we will give some updates on the company results on Sembcorp Marine, China Sunsine, REIT sector, and Hobbyland. Then after that, we will talk about the Phillip monthly recession checker. So now let's look at Sembcorp Marine. So Sam Marine last week announced their first Q results. You can see the table here. So actually, the result was not good. You can see that the bottom line, the net profit, dropped substantially. It was due to the weak profitability resulting from the shrinkage of the net order book. So in first Q, Sam Marine secured a new contract for the construction of a new build FPSO, but the contract value was not substantial for Sam Marine. So you can see the total contract size was only about 476 million Sing dollars. And also in first Q, Sam Marine started to adopt the SFRS 15. So because of this, the top line actually was boosted a bit. So excluding the effect of this new adoption of new accounting rules, the revenue growth was actually about 15% year-on-year growth. So it will translate it into about 33 million Sing dollars net loss in first Q. So you can see that actually the profitability in first Q was very bad. So the net order book continued to shrink, and as of first Q, the floating LNG business was still very quiet. That means though there were a few inquiries of this floating LNG, they did not successfully translate it into the new orders. So the outlook for Sam Marine is very gloomy because like our previous sector update, the upstream drilling and production sector remains soft. As of now, the upstream, the drilling vessels were still oversupply, so it will take longer than expected for the market to digest the outnumber vessels. So next, we'll talk about the China Sunsine Chemical first Q results. So actually, first Q, China Sunsine continued to deliver an outstanding result. We maintain our buy call with a higher target price of $1.97. Our previous target price was $1.60. You can see a table here. Actually, the results were very good, all from top line to bottom line. Actually, growth at more than 50%. That was mainly due to the higher average selling price as well as the sales volume. Because in first Q, the domestic market was still experiencing the shortage of supply of rubber chemicals. So as a market leader, China Sunsine continued to enjoy higher profit margins. So accordingly, the GPM and NPM was recorded at a historical highs in first Q. And also in first Q, China Sunsine was granted the high-tech company status. That means that tax rate will be reduced by 10 percentage points from 25% to 15%. So the update for the trial run status, according to the management, the respective 10K ton of the TBBS and insoluble sulfur plant is expected to get the approval by 2Q18. So it is expected that the trial run could last for 1 to 3 months. That means hopefully by third quarter or fourth quarter, these two plants will enter into full operation, so that it will contribute a bit to the top line and bottom line. So the outlook for China's Sunsine is still very bright, as we expect that the domestic environmental protection policies and regulations will be more strengthened. That means there will be more small and medium-sized plants shut down before the new capacity from this large cap to enter into the market. So moving forward until the end of this year, we expect the shortage of supply will persist, and that will be benefiting Sunsine to enjoy higher profit margins. So next, I'll pass on to Richard to talk about Ascendas REIT.
Thank you, Guangzi. This is Richard speaking. I'll talk about 3 of the industrial REITs under our coverage. So first, Ascendas REIT. We maintain accumulate target price 291, and we forecast a full year DPU of 16.1 cents. That will give you a 6% yield based on the last close price on Friday. So Ascendas REIT announced their full year results. You can see from the chart here, top line revenue growth was 3.8% as usual. Most of top line growth is usually coming from acquisitions. So in this case, it was the Science Park Drive, Carwood Street, and the 2 properties on Wickham Street in Australia. This largely flowed through to NPI, and finally DPU for the full year was 1.6% higher year on year. Overall, the portfolio has been stable. In terms of its valuation, there was some slight tightening of capitalization rate. The overall blended portfolio cap rate was 6.29 last year, and this has tightened to 6.24%. Overall reversions were pretty healthy. Net positive reversion of positive 0.7 for the portfolio. Of course, some negative, some positive, but overall blended is 0.7%. Occupancy also was higher quarter on quarter, just marginally, so nothing exciting to talk about for occupancy. Balance sheet also is still healthy, 34.4% gearing, and at this level of gearing, the available headroom has a potential to grow the asset base by another 10%. So outlook is largely stable. The rents are recurring and no major impacts to rent expected for FY19. The portfolio is well diversified and able to weather short-term localized impact. So the manager is most optimistic on business park and high specs, and the localized impact I was talking about is a logistics asset. So the manager for the REIT is cautious on their logistic assets. As you know, there has been quite a fair bit of a new warehouse space coming up in Singapore, and so that has been an oversupply situation for the last 2 years at least, and we still need to see some absorption of the space that's available. Next, we move on to Mapletree Industrial. So we maintain neutral for Mapletree Industrial. target price is 209, and DPU forecast is 12.11 cents. They'll give you a 6% yield based on the last close price on Friday of 2.02. So they also reported their full year results ended March. Gross revenue grew 6.7%. This is coming from their organic growth of their build-to-suit project for Hewlett-Packard. This project is a fairly big project and contributes about 10% of their income. Something that you see different is this line here, share of profit from joint venture. So last year they didn't have any. This year there's 21.8 million. This is coming from that joint venture they did with their sponsor Mapletree Investments to acquire that portfolio of 14 data centers in the US. So this, because it's a joint venture, is reported separately, equity accounted. Take note that you see this 21.8 million. Not all of it is actual revenue. If you see the comments here, actually only 3.9 is coming from profit after tax, while the remaining 17.9 is actually fair value gains. This is fair value gains on the value of the properties. So last year there was no number for this. This contribution was started in the late part of third quarter, the FY. So that means that's in the late part of the calendar year 2017. Right down to the bottom line, DPU is 3.2% higher year on year. So we still see a growth in DPU for Mapletree Industrial despite some of the headwinds that the local industrial REITs are facing. Just like A-REIT, the portfolio value also has been stable with slight tightening of capitalization rates. Capitalization rate for were tighter for the flatter factories, high-tech buildings, and stack-up ramp-up buildings. Cap rate for business parks were unchanged, and light industrial buildings widened. So gearing also remains relatively low at 33.1%, and this will give it an available headroom to grow the assets by 8%. What is different from A-REIT is weighted average rental reversion of negative 2.2 and lower occupancy from 90.1 to 89.6%. Outlook is stable. So what we're seeing is a contribution from the joint venture platform of US data centers should be sufficient to offset any weakness they see in the Singapore side of the portfolio. The manager expects softer flattered factories, but business park remain fairly strong. One reason why we have neutral on Mapletree Industrial is in terms of valuation. If you look at the chart on the bottom right corner of the slide, this chart is showing the forward price to book price to book multiple since 2011. That's roughly when the REIT first IPO. So you can see that the price to book in terms of valuation, the price to book is already at the positive 2 standard deviation above the average rate. So we are quite cognizant of the risk of reversion to mean for the price to book. Okay, then the next is for Cash Logistics Trust. So we also maintain accumulate for cash Target price slightly lower at 91 cents. I think it's unchanged, 91 cents. DPU that we forecast is 6.05 cents. That will give you a 7.2% yield based on last close price on Friday. So you can see gross revenue grew quite significantly, 7.3% year on year. This is due to inorganic growth where they acquired 9 warehouses in Australia. This was completed on February 15, so it roughly contributed about 1.5 quarter of revenue. That's the main revenue driver. If you look at distributable income line, it's lower by 0.6% year on year. Take note there's some one-offs in it and difference in comparison. So for the first quarter last year, there was a capital distribution. So if you exclude the capital distribution from last year, then actually the underlying distributable income this year is 5.5% higher. Also take note that this year, this distributable income to unit holders is after distribution to perpetual security holders. So last year there was no perpetual security holders. So that actually, if so, going down to DPU, DPU is 16%. 16% lower year on year due to this is the effect of the larger unit base of the rights issue and the effect of the capital distribution as well. So if it's restated to account for the rights issue, then DPU will be lower 12.5%. Australia. So how the status of the portfolio now, the WALE is longer quarter on quarter from 3.4 years to 3.5 years. This is mainly due to the addition of this acquisition of the Australia warehouses. So when at the time of acquisition, as of December, the WALE was 5 years for that set of portfolios. When you add 5 to 3.4, now the WALE has extended to 3.5 years at the end of the first quarter of this year. Current leverage is at 38.5, but it would be lower to 35.2. The reason for that is there's a pending divestment of one of their properties. That's a high-speed logistics center, and they will be using the divestment proceeds to pay down debt. So after they pay down debt, that's how the aggregate leverage will reduce to 35.2%, and at that level they will have a headroom of about 108 million. So if you assume a 40% gearing, they can grow their AUM by about 8%. Some other forward looking numbers which already has been overtaken by events would be their occupancy. So as of first quarter, they reported 97.3% for their portfolio occupancy, but actually as of today right now, it should be lower than 97.3 already, because that's due to the conversion of CWT Commodity Hub, which was converted to a multi-tenancy on April 12. So April 12 is after 31st March. So they will report the 31st March occupancy, but at this point in time, it's already lower because CWT Commodity Hub was previously a master lease, so they would account for it as 100% occupied, but now that it has been converted, it's 86% occupied. So current occupancy of the portfolio is probably slightly lower than 97.3%. I mean, a ballpark number maybe should be about 95, 96, thereabout. Distribution, one thing to note is that distribution to unit holders also has been eroded by the distribution to perpetuity security holders. So you can see that as I mentioned just now, the underlying distributable income would have been 5.5% higher year on year if you exclude the capital distribution. Also likewise, you take a look at right here, net property income is 10% higher year on year, but DPU is lower. So the thing is that the portfolio size has grown, but some of that growth has been attributable to using the perpetual securities to grow that portfolio. And so not all this growth in NPI will flow through to the unit holders. So outlook for cash is stable. Why we say this is because the renewal risk for the remainder of this year is limited to 6.7% of GRI, that's gross rental income, and take note also that there's a tapering supply this year as well. So that should ease some of the pressure that the warehouse segment has felt in the last 2 years. In terms of conversion risk, there's none this year as well. There's no conversion within this 6.7%. The next master lease renewal will be at Precise 2, and that's next year, near the end of first quarter or early second quarter of next year. Now we'll move on to Te Hong, who will talk about the rest of his coverage.
Hi, good morning clients, Te Hong here. I will go on to touch on 4 other REITs that reported, 4 other REITs under our coverage last week. So out of these 4, 3 of them will be on accumulate, and I have 1 on neutral, so I'll start off with the neutral one first. For my neutral one, that's FCT. Results came in basically on the numbers wise. You see that revenue, there was a close to 7% growth, and the reason for this is, as we all know, North Point, the renovations has been done, and that mall actually reopened in December last year. So in first Q last year, you actually have it that it was from a low base effect because it was under renovations, and then right now there's the new tenants coming in as well. So there was a 7.5% increase in revenue for first half, and distributable income was not up as much, and the reason for this is because, as we all know, last year, because of the drop in income due to the renovations, the management actually took more management fees in units. So the result of taking more management fees in units is that you free up more cash for distribution, and that period of time they were doing this because, as I've said, income was down. So right now they are reverting to taking. This quarter, they took management fees in units about 40%, and we are expecting this ratio to go down to the normalized 20%. So all in all, DPU grew about 2% for second quarter 18. I think on the operating metric side, what are some of the positives to us is that overall portfolio occupancy is up slightly to 94%. The big malls, the Causeway Point, the North Points, they are still pretty okay. I think the weakest mall is still, as we all know already, Bedok Point is still undergoing tenant readjustment. So on the portfolio rental reversion wise, there was a very, very strong 9.1% in second quarter, and the reason for this strong reversion is because of the renewal of a lease for an anchor tenant at Causeway Point. So that lease was actually signed 5 years ago. So if you take into account second quarter and first quarter, so for one half 18, overall rental reversions was about 3+%. 3+%, I think, is pretty decent in the challenging retail environment. But the thing is, okay, firstly is because all this while this FCT's occupancy cost has been lower, so they are able to stretch more now, even though tenant sales are not growing in tandem.
And then secondly, even though you see that 3+% is pretty decent by current environment standards, it actually represents one of the lowest numbers that they have done. If you look across the last 10 years, their rental reversions have ranged between 5% to 15%. So if you do right now a 3+%, actually you see that the rental reversions is actually one of the lowest numbers in recent years. And for another positive that came out from the quarter is that financing cost has been pretty stable. Their all-in cost now is about 2.4%. It's up slightly, just about 0.1%. And for FCT, we know that they are having 56% of debt hedged on fixed rates, and this is actually one of the lower percentages amongst all the REITs within the S-REIT sector. We know that the average level of debt hedged is actually close to 76%. So at 56%, FCT is doing on the lower range, and management has actually indicated that there has been no inclination to hedge more on this. So on the negative side, as I mentioned earlier also, is that portfolio tenant sales, as we also saw in CMT's full year, CMT's 1Q numbers came in flat as well. Then along with this CMT's portfolio tenant sales, FCT's tenant sales is also displaying a similar trend. They are actually pretty lagging to what we are seeing on the general retail sales index. So on the malls front, FCT tenant sales year on year is down 1.2%. We're maintaining neutral on this REIT because for this year you can expect that the completion of the renovation works at North Point, this will actually continue to be the driving catalyst for earnings this year. But then because of the fact that we also expect the percentage of management fees to be paid in units to gradually go down from last year about 70% to this year we expect it to fall to 20%. So this concurrent action of taking less fees in units will actually offset some of these improvements in earnings. And for FCT, the other major risk that we see is that if there is a sharp rise in interest rates, given that 44% of their debt is on floating rate, they could be hit harder than the other REITs who are hedged more. So what we also understand from talks with management is that if you look across last year, the theme was that despite a bit of going up on the base rates, but the bank spreads have been thinning, because we all know that the loans to REITs is based on SOR plus a bank spread. So last year the theme was that despite the base rate going up a little bit, bank spreads have been coming down because the banks were more desperate for REITs business. So that actually offset some of the rise in the base rates. This year the trend is that the comments from management is that the bank spreads are remaining pretty stable. So we no longer see the compression, but they are remaining stable. Okay, I'll move on to the next one, CapitaLand Commercial, the office space. This one we have actually upgraded it from neutral to accumulate. At the start of the year we were more cautious. Right now we have actually upgraded it to accumulate with a corresponding increase in the target price from 180 to 188. The reasons I'll touch on in a while, but for now I'll go through some of the numbers first. Revenue was up 8%, and think most of this increase was primarily from the acquisition of AST2 in September last year, and there was also higher income from some of these buildings because of better occupancy, and that offset the loss in revenue from divestments. So there was also increase in finance costs because of the increased borrowings for AST2's acquisition. So all in all, adjusting for the enlarged number of units from the rights issue, DPU actually grew 7.6%. On the positive side of things, for CCT, you see that grade A office rents, we know that they have bottomed since 3Q last year. Since then, the momentum has been very strong. And in 1Q, we saw a further 3.2% quarter-on-quarter growth. So in the 2018, previously our concern at the start of the year was that because you're renewing leases signed 3 years ago where the index was at a peak, so there's a risk for negative rental reversions and the risk of earnings not being able to catch up. So what happened in the quarter for CCT is that they renewed about 100,000 square feet of space, and with this renewal of that amount of space, there is actually minimal leases left for renewal this year. They have only 5% left for renewals this year, and of those leases that were renewed this year in the first quarter, we saw that versus a situation we saw at the end of last year where the expiring rents versus the newly committed rents, we saw last time what happened was that the expiring rents were either in the middle to the top of the range of the newly committed rents. So I repeat, the expiring rents were either in the middle of the range or top of the range of the newly committed rents, meaning to say there's a higher chance of negative rental reversions. This time round in the first quarter, expiring rents were looking better. They look to be in the middle of the range or at the low end of the range of this newly committed rents. Even though this might be just a one-off occurrence in one quarter, but then that also mitigates the impact of any further renewals left for 2018, because as I mentioned, they only have 5% left. And so because of this small little risk left in 2018, and we also see that quarter on quarter rents are improving at a pretty rapid pace. So the 2019 lease expiries, they will benefit from these rising rents from now until then, which we expect rents to carry on rising, because you know that last year was the peak supply. That peak supply has been gradually absorbed, and from now until the next 2 years, until 2020, there will be a tapering of supply. Supply is tapering, demand is improving. I think from now until the next 2 years, you can expect a continued recovery in office rents. So this continued recovery will mean that we will be less worried, even though you see that about 30% of your leases will expire in 2019. But I think the most important thing is this year, at least, you're more mitigated on that front. And that is on the lease renewal side. On the debt side, so debt side, they have also fully financed everything due for this year. There's nothing due left for this year. So what we observe from the CapitaLand family is that they generally are more conservative, not just CCT, across the CapitaLand REIT family, CapitaLand Mall, CRCT as well. They have mostly been very proactive to forward refinance whatever is due in 2018. So most of them, you see that 2018, nothing much left. It's for CRCT's case, which I will touch on later on as well. You see that they are also even trying to forward renew some debt in 2019. So for CCT, they're pretty secure now this year. Nothing much left for refinancing. And what is the negative that we can see for the quarter is that even though on the whole as a group, this average cost of debt has just crept up slightly from about 0.1% to 2.7%. But we saw that RCS Trust, the trust which holds Raffles City, they actually have done a 6 or 7 year tenure MTN. That's just in last month. That MTN was done at an interest rate of about 3.2%. And last year, in the middle of the year, the same RCS Trust did a similar tenure MTN. That tranche actually cost them 2.6%. So year on year, you actually see quite a big jump in the financing cost for this RCS Trust from last year 2.6% to this last month's 3.2% for a similar tenure. So that will be one of our main concerns for now. But on the whole, because this year nothing much left for refinancing, so I think they are pretty much well insulated for the time being. And also, if you're talking about next year's refinancing, then hopefully by then rents would have increased and next year income would be able to catch up from you have multiple drivers. You can have improving occupancies from acquisition in the Asia Square Tower 2. That can actually top up the income to mitigate all these increases in expected increases in interest rates. So our upgrade to accumulate with the higher target price of 188 is a function of our increasing of our expected DPU in 2019 by 3%, and that is a function of the fact that we are seeing that office rents are growing at quite a rapid pace, up 3.3% as I mentioned in 1Q. So for this year, lease renewals, the risks and the interest rate refinancing risks, they have been largely reduced. No debt expiring, only 5% of leases expiring this year. Therefore, we feel that the DPU outlook is actually pretty stable. You add all this to the fact that near-term growth drivers, you also have contributions from Asia Square Tower 2 and the potential increase in occupancy rates at that tower, which is I think currently about 90%. And a bit further down the road, midterm, you have the completion of Capital Spring in 2021 as well. That will be a midterm catalyst. So the next one we have is jumping out of Singapore to China on the retail front. Okay, let's see. This one we have not changed anything. We have not changed our forecast. We have not changed our target price. The upgrade from neutral to accumulate is just primarily a function of price weakness that we have seen since the start of the year. There has been a lot of interest rate volatility worries in the late few months. So the REIT sector and CRCT included has also suffered quite a dip in the share price. So with the drop in the share price, we have our current target price, which is unchanged, has actually represents quite a sizable upside, including dividends, including the 6% dividends. So that's the reason for our upgrade. I'll talk a little bit about the numbers first. This number, you see that is down, but do not be too alarmed. This down is just because that they have divested a mall last year in July, and Grand Canyon, there was a bit of drop in revenue as well because they have some high-level government conferences carrying on in the vicinity of the mall. So they actually had they will impose some restrictions on the trading activities at the mall's atrium. So that actually contributed to the drop in the revenue. But if you exclude all this divestment impact, same mall MPI is actually pretty flat. It's up 0.6% year on year, and the average exchange rate that we saw last year versus this year is actually pretty similar. It's around 4.83. So all in, distributable income grew despite the fact that gross revenue fell. This is because there was loss of income from Anchen, but then there was also a top up in the using the divestment gains to distributable income. So that's why you see that all in distributable income actually grew, but because there were higher number of units, because they did a placement in December. So all in, you are seeing a DPU coming in at rather flat. Positives on the results front is that there has been an improvement in retail sales. FY17 we saw that it was doing about 0.8%. So this quarter is up about 2.1%. And I think for CRCT, their main malls in Beijing, they have 3 big malls in Beijing. These malls are doing tenant sales about stabilizing about mid-single digit range. So they have some AI works going on whereby they took back some anchor tenant space, departmental space from the departmental store operator, and then they converted it to more than 20 lifestyle brands. So this will be starting in one of these Beijing in Wangjing. So this AEI and also the tenant readjustments in Rock Square in Guangzhou, this will actually, I think, sustain the tenant sales going forward for these malls. And these malls actually, so the three big malls I talked about, which are doing stable tenant sales of about mid-single digit plus Rock Square, these make up easily more than 50-60% of the portfolio valuation. And this capital distribution from divestment gains, I've talked about it. And like I mentioned before earlier on as well, in 2018 there will be no refinancing needs. They have refinanced everything, and so there will be no more refinancing risk for this year. And the negatives will be that they have two struggling malls. These malls are either hit by supply in the vicinity or road closures. So these malls have been struggling and they have yet to show any signs of improvements. But the good thing, the flip side of it, is that these two malls only occupy close to 5% of CRCT's total mall valuation. So all in, we upgrade this CRCT to accumulate, and as mentioned, is because of the recent price weakness. We feel like after seeing what has happened this quarter, with the Wangjing AEI being successful, ROI is more than 30%, and you see that, remember last year or the year before, they acquired Xingnan in Chengdu. When they acquired it, yield on cost is actually about 5.4%. At that time, it was actually lower than the CRCT's portfolio NPIU as a whole. So the promise and the target at that time was to build it up to through active portfolio management, active mall management, to a close to 6.3% yield on cost. And I think looking at the numbers this year, it looks like they have delivered on that target, delivered on that promise. So I think we are seeing pretty proactive mall management on the front. And so with the recent price weakness, we are upgrading this to an accumulate. So last but not least, this will be Hobbyland, the only developer that is under our coverage and has reported so far. For the rating is unchanged, accumulate target price is also unchanged. Numbers wise, I think what is important to note is sale of development properties, there is a jump, but even though the percentage wise is big, but it's just a one-off sale of a site in Gold Coast, and this we all know is always lumpy. So the rental income now these few years actually has been making up a bigger percentage of Hobby's revenue. And if you look at the recurring income portfolio, it's actually pretty stable. So all in, on the positives for the group in the quarter, they also mentioned that this year will be the year that they will relaunch the Sentosa properties that they have. We all know that they have been stuck with 3 condominiums there over the past few years because of the cooling measures that the government has imposed. So no way to monetize over the last few years. They've been leasing it out, and the rental occupancy has been about 80%. This year could be the year that they finally launch and monetize these projects. I think this is one of the reasons why they're trading at such a big discount, because of this inability to monetize these assets in Sentosa, as well as some of this office portfolio in UK, in London, which they have because of the worries in Brexit. So I think these are the two main causes why they are actually doing such a big discount. But now I think with Sentosa due to relaunch this year, at least a little bit of some of this uncertainty or this drag on the discount is actually can actually be some light at the end of the tunnel. And we don't have the chart here, but if you look at our reports, there's actually, we know that in Sentosa, for all the condominium transactions, 1Q18, actually there was a rebound or improvement in transaction volumes. So there were total 17 transactions done this quarter. It doesn't sound like a lot, but then you have to note that there aren't much supply in Sentosa as well. So we are just talking about condominiums in Sentosa. In one quarter, in first Q, there was 17 done already. And this 17 is actually the highest since 2012. So we note that there has been an improvement in transaction volumes, even though prices have been still languishing around the 1,600 PSF mark. But even with that, our assumed capital value for these three properties is actually 1,005. So we are still on the more conservative front. So I moved back to Singapore on the rental front. I talked about rental income being the bulk of the income. I think this Metropolis, the Grade A office tower in Buona Vista, that actually, by our estimates, contribute about 57% of total rental income. So it's a very important asset for Hobby. That one remains 100% leased, and this year there's about 30% of leases due for expiries. So with average rents range in the range of $7.50 to $8 PSF, we will be expecting flat to low single digit reversions. We've talked to management. The expectation is that minimally they are expecting flat renewal. So not too bearish there, not expecting any negative rental reversions from there. So at least you know that from this rental portfolio wise is quite stable. And another thing that happened to them is also that they bought into this property fund, Credit Suisse property fund, that will focus on commercial assets in Europe, predominantly Germany. And this may not be the most ideal way we would like our developer to make money for us, because if you look at using a fund to grow, that's like if I were to be a global fund manager or high net worth, I would have access to these funds as well, right? But the thing is, I think at least we are seeing that they are okay. The targeted IRR for this fund is about low teens, so that is on the fund front. So the fund IRR is about low teens, but there is a chance for further IRR upgrade if the group is able to utilize their balance sheet to gear up for these fund investments. So I think at least there has been some putting the balance sheet to good use on this front. And one of the negatives is that they have been adopting a pretty conservative approach to their land bidding. Over the last few years, we saw a lot of activity on the land bidding front. A lot of developers have joined in the action. But Hobby, over the past few GLSs in these 2 years, we have not seen their names. We have not seen them taking part in any of these bids. And I think one of the reasons also because they are stuck with these Sentosa properties, not so if you were to re-enter another bid, then your exposure to Singapore could be overly large. So I think that could be one reason. The only bid we have seen them take part in is the Punggol EC sites, but even that one, they came in the lowest, the bottom, and their bid was about 27% lower than the highest bid from CDL. So I think this no additional land bank even inventory will be one of the negatives to us, but we are still maintaining accumulate. I think the focus should be on this. If you look at the rental income, it's actually a very, very strong portfolio. Metropolis, this total rental income that they're having is actually sufficient to cover 3 times whatever they paid out, ordinary dividends they paid out last year. So last year, total dividend was about 10 cents. Ordinary was 8 cents. So if you assume that dividend to maintain 10 cents, you're actually looking at a 4% dividend yield. So you'll be paid 4% to wait for any monetization of their portfolios. I think that's pretty decent. If you look at the discount to NAV right now, 45% is one of the highest amongst all these listed developers. So like I mentioned, the biggest pullback for them, I think Sentosa and some of these Brexit concerns. But Brexit, we are also not too overly worried because leases are long. There is a 5-year upward only rental revision, and then there's this natural hedge of using debt in the same currency as well. So all in this, I think this year successful relaunch and monetization of this Sentosa properties anywhere above our assumed 1,005 PSF capital value will be a catalyst for the first is the narrowing of the discount to the NAV, and then secondly is also the upgrade in the RNAV. So with this, so before I move on to the recession tracker, with all these REITs reporting this week, all the REITs under our coverage would have reported. And so to summarize what are the calls we have, the 4 accumulate or buy calls that we have under our coverage will be all presented today already. They will be Ascendas REIT, Cash Logistics, CapitaLand Commercial, and CapitaLand Retail China. I don't have the summary table with me where I have all the gearing ratios and all the debt expiring, because some of these REITs not all the REITs have reported. So I'll present to you in due time when all these numbers are out. So with that, I will pass on to Jeremy to talk about our recession tracker.
Hi, good morning everyone. Jeremy speaking here. So let's just shift our attention to the US side of things right now. Taking a look at the monthly recession tracker for the April update. So basically in April, what we saw was probably the thing that you see in the screen right now, back to normal after last month in March where we saw some early crack signs. So probably I'll just illustrate what I mean by that in the following slide. So here's the summary of the recession tracker in April, the performance. And probably the main thing I want to highlight over here in this particular slide is for those that haven't been following the recession tracker, basically it's a list of indicator that's being separated into 2 groups, market-based data as well as economic-based data. And all in, you can see over here in the most recent number that we saw, at least from a recession tracker perspective, we see more greens than red. Greens meaning improvement from the prior months. And ultimately, all in all right now, we are seeing some further improvement from the market-based data as well as the economic-based data. And key highlight in the month of April is we saw some mean reversion from the crack signs that we saw in March. Basically, some mean reversion happening within the 210 spread, the VIX index and the TED spread. And all in all, the economic-based data are right now still at multi-year extremes, which is pretty rosy in our perspective in terms of economic-based data, showing strong positivity out there. I will just highlight a few slides for the indicators of what we see the improvements are. So let's dive into it. So again, to highlight TED spread here, what we saw is in April, we saw some mean reversion happening, tapering off the 63 basis point high somewhere in middle of April. But probably just to highlight again for those that haven't been following, rising TED spread is something that isn't really good. When we have a rising TED spread, it's actually signaling to the market that there is a heightened uncertainty within the interbank level. And ultimately, back in February, March period, that was when we saw the sudden spike in the TED spread, breaking above the 36 basis point range high. And since then, we have saw TED spread suddenly spike up to a high of 63 basis point from a level of 36 basis point. And just to highlight again, in April, we suddenly saw a kind of reversion of this steepening trend, which we took as a sign of relief from the market. And moving forward, continue to watch this space. Ultimately, the level that will kickstart the bearish sentiment is the 1% level from the TED spread perspective. But as of now, we are seeing that the TED spread is moving back to a normal level, which is the reason why we are still kind of bullish on the US equity market, at least from a TED spread perspective. And on the VIX index side, same thing over here. In the month of April, we saw the VIX index kind of tapered off the 25 high, and moving back comfortably back below the 20 range, which is some level that is more kind of comfortable for the market to move back on the risk on side. But moving forward, our expectations, at least for the VIX index, is for it to remain pretty subdued. Main reason behind is over here you see on chart, the bottom panel shows you the CFTC VIX futures non-commercial net total position, basically showing the market bet that they have on the VIX index. So right now the speculators are extremely long the VIX index, and we are expecting a long squeeze to happen within the VIX index in due time to come. And what I mean by a long squeeze is, you can see over here, historically, whenever the net position of the speculators exceed 15,000 contracts, a long squeeze in the VIX index is not too far away. So the vertical lines over here on the chart, these 3 points over here in 2015 February, in August, as well as in February of 2016 was when we saw the long squeeze happening, when we have extreme longs within the VIX futures. And what that does is, when the long squeeze happen within the market, the VIX index will kind of taper off from its high, and we definitely see limited upside within the VIX index when the speculators are extremely longs. So during those 3 periods, we saw the VIX index kind of came off the high by 27%, followed by 44%, as well as 36% on these 3 occasions. So right now, in terms of positioning wise, the VIX index markets are kind of expecting or betting all on one side, on the long side of things right now. We are seeing unprecedented long, extreme long at 92,000, 913,000 contracts. So that by itself is an extreme long that we haven't seen before in the market, and with that extreme long, we are expecting an imminent long squeeze to happen within the VIX index, which is why we are expecting the VIX index to stay kind of subdued below the 20 range in the near term, until this particular positioning within the speculator space rebalances. So by that, probably once we see the net position in the speculator space kind of tapering off this 92,000 high to a more normal range of maybe negative 5,000, probably that is when the VIX index can actually rise back to the higher side. As of now, in the near term, we are expecting the VIX index to hold with a high of around 20 to 25, and probably stay comfortably below the 20 range, and probably move in a range bound manner between 15 to 20. And that should be positive on the equity side of things. And then moving on to another positive indicator, the 210 spread, which basically shows you the yield curve. We have been moving in this flattening trend since I think 3 years ago, but probably some sign of relief is in mid-April. That was when we kind of moved back into a mean reversion of this flattening trend of this 41 basis point low. But ultimately, this move hasn't really been sustaining. We saw even last week the flattening trend came back into the market. So all in, long-term trend, at least on a 210 spread perspective, is still flattening, but just some sign of relief is that in mid-April we saw some steepening happening in the market. On economic data front, consumer sentiment remain on the high side. All in, like I mentioned over here, you can see, I just want to highlight the Bloomberg Consumer Comfort Index continue to outperform the market expectation. In April, actually hitting another new record high of 58.1. And this is a level that has been higher since year 2001 over here. So all in, consumer sentiment, not just on the Bloomberg side of things, we saw University of Michigan as well as the Conference Board survey provider also showing strong improvement in the month of April on the consumer sentiment side of things. And all in, the general trend of the consumer sentiment remain on the high side. And with the positive correlation that is being fed back to the equity market, with this beat in April, we expect the risk-on sentiment to come back into the equity market in the near future. And then another nice performance over here is the labor market, more so in the weekly unemployment claims. So weekly unemployment claims number kind of a short strong growth again in April, as it fell to a low of 209,000 claims, and this is actually the lowest level since 1969. And on the chart over here, you can see this particular low is the most recent reading that we got last week, and it was the lowest level since 1969, which shows you how strong the labor market currently is. And just to put things in context, in the month of March, the number was at the lowest since 1971, which is this point over here. So all in, we are seeing strong growth within the labor market on the weekly unemployment claim side of things, which should then translate into also stronger numbers in the unemployment rate data that's coming out this Friday. So keep a close lookout. Last month's number came out at 4.1%. We expect this Friday number to probably, with this strong unemployment claims number, we expect the unemployment rate to probably stay at worst at 4.1%, or kind of a bit expectation to probably 4% or even 3.9%. and this should again feed back into a positive equity market in the near future. Okay, so probably just dive in a little bit more on the most recent happenings within the equity market, at least last week. The key theme that has been shaking the market is this 10-year Treasury yield, how it actually broke above the 3% level last week and caused some market near-term turmoil last Tuesday and Wednesday. But ultimately, just to highlight why the market is placing so much emphasis on the 3% level on the 10-year Treasury yield, on the chart over here is the monthly time frame on the 10-year yield, and the red line over there is the 150-month moving average. So just to illustrate why I draw this red line over here, basically the red line, the 150-month moving average, is the dividing line between the bulls and the bears. And as you can see over here, where we have the 10-year yield below the 150-month moving average, usually it's telling us that the bond market is in a bull market, and the yield will actually respect the level and move in the downtrend manner. And you can see over here, since 1985, once the 10-year yield actually broke below the red line over here, that was the point whereby we saw the 10-year yield actually confirming this particular downtrend and confirming that the bond market has moved into a bull side of things. And since then, we have saw like 6 reaction point with the 150-month moving average capping the ascent every single time it tests the red line. And that proves the point whereby this 150-month moving average is a well respected number that the market is currently watching. And hence bringing you to where we are right now. We are again testing this red line, which is the 150-month moving average. To be specific, this level is at 2.93%. But all in stacking with technical levels, I think the key level right now that the market has to watch is this 3.05% level, which is the January 2014 high that we saw back in 2014. So all in right now, we are talking about a bond bull market that has been going on since 1985. And in terms of how this will flip out and turn out, what is needed is at least on a monthly perspective, if we do get a monthly close above the 150-month moving average and the 3.05% level, probably we will be seeing the early stage of a bond bull market turning into a bond bear market, which the market hasn't experienced such a movement since 1985, which in our opinion is something that the market is not ready for. So in the near term, I think what we have to watch out for is if this 3.05% level holds, we believe the risk on mood will kind of return back into the market. And on the flip side, if we do get a daily followed by a weekly and then a monthly close above this 3.05% level, then probably that will spell some near-term market turmoil, whereby we see risk off kind of a sentiment kicking back into the market. So keep a close lookout at this 3.05% level in the 10-year Treasury yield market. But our expectation is for this 3.05% level in the 10-year yield to hold, mainly again due to the positioning within the speculator space. So the bottom panel over here shows you the CFTC 10-year US Treasury yield note net non-commercial futures position, and the top panel shows you the 10-year Treasury yield. And based off our study, what we see is historically when the positioning within the speculator space exceed below the crowded short level, which is negative 210,000, short squeezes tend to happen, shown by the vertical lines. So you see every single vertical line in the chart since 2004 is the point where we saw the short squeeze happen, and short squeeze tend to leave price of the bonds to the upside, and hence on the flip side the yield will fall. Historically it's been true whenever the 10-year yield falls below this negative 210,000, and hence right now with the speculators right now again extremely short at negative 375,000, we are expecting a short squeeze within the bond market to come pretty soon, and that will have a resulting effect of putting a cap in the 10-year yield at probably 3.05%. And our estimation is with this short squeeze, the 10-year yield could probably move back to a range of 2.7% to 2.5%. And only if that happens, we should see the risk on kind of a sentiment coming back into the US equity market, and that should leave us back into the uptrend for the US side of things in the equity market. And hence, that brings us to the last part, the price action on the 3 main indices. So overall, in terms of level-wise, I think cross-currency, cross-asset correlation is holding up pretty nicely. So like I mentioned, the key level on the US 10-year Treasury yield is at 3.05%. And hence, on the flip side, we are seeing key levels at the 200-day moving average on all 3 major indices, the Dow Jones Industrial Average, the Nasdaq 100, as well as the S&P 500 index. So as long as the 3.05% in the 10-year Treasury yield holds, then we are pretty confident to call for the 200-day moving average on the Dow, S&P 500 index, as well as the Nasdaq 100 index to hold as well. And that should leave us back into this uptrend that I will show over here. So on the Dow, there is a more interesting price action that has been building up in the month of April. So 200-day moving average has been supporting price since this 12% sell-off. And even with the most recent sell-off over here, you can see this 200-day moving average has been stacking up again, keeping a solid floor on price. But ultimately, is this price action over here that it's interesting is how the Dow Jones Industrial Average actually broke above this particular downtrend line and kind of gave us an early hint that the bulls are interested in taking the uptrend back. So all in right now, we are remaining bullish on the long-term perspective as well as the near-term perspective for the 200-day moving average to hold and probably for the uptrend to return on the three major indices. So same thing over here on the S&P 500 index, the 200-day moving average has been holding price up. And again, like I mentioned, the most recent sell-off, you can see how this 200-day moving average has been stacking up, keeping this solid floor on price. And this coincides with a multi-year uptrend line since the Brexit low. So all in, strong support over here in the S&P 500 index, somewhere around the 2,600 psychological round number. And we are expecting the uptrend to return for the S&P 500 index as well. And last but not least, the Nasdaq 100. Same thing over here to highlight the 200-day moving average as the key support level to watch, as well as this multi-year uptrend line that I've just drawn over here. So all in, we remain pretty bullish on the US equity market as we see further improvement in the recession tracker in the month of April. And ultimately, we are expecting the 3.05% level in the 10-year Treasury yield to hold, and hence that will feed back to the US equity market, where we will see further risk-on sentiment coming back to the market with expectations of the 200-day moving average in the three major indices, the Dow, the S&P 500 index, as well as the Nasdaq 100 index to hold, and to see the uptrend within these three indices to kind of kick back into gear. And ultimately, right now, the near-term target for these bulls, for this particular uptrend, we are expecting the Dow to hit back the 25,813 points-ish level, the S&P 500 index to hit back the 2,800 psychological round number, and then for the Nasdaq 100 to retest its 7,047 point resistance area. Yeah, and with that, we've come to the end of today's webinar. We will pause right now for Q&A if there is any. Thank you.
Hi, this is Richard speaking. There's a question to clarify what's the meaning of tighter cap rates. Tighter cap rates means that the capitalization rate has become a smaller number. Capitalization rate is just a is property value divided by net property income. And then there's a follow-up question with the 10-year yield. Generally, if all things equal, when interest rate increase, cap rate will increase as well. So that's why you will hear these kind of comments like property value coming down as the as the interest rate rise. So the relationship is all things equal. If a cap rate become a smaller number, the property value actually increases. It is Richard again. There's another question on Frasers Logistics and Industrial. Actually, we don't cover that, but there's a question on what's the view of the German property acquisition. So just to clarify a little bit, the properties that are acquired are in Germany and Netherlands. Germany-wise, it has the largest GDP among the European countries, and Netherlands is within the top 10 largest for GDP. And I think that for Netherlands, they have quite a good GDP growth forecast for this year. In fact, the forecast for GDP growth for Netherlands is actually even higher than that of Germany as well. So for Netherlands, probably it's like a growth. You're buying for the growth factor, whereas for Germany is more of the stability. As you know, Germany is one of the most stable economy in Europe.
Hi guys, Toh Hong here again. There is a few questions on Hobby. I will address them one by one. So one of the question is that any idea why they're not bidding new land sites in Singapore, but yet taking part in overseas projects and then taking on higher risk for more uncertain returns? I think okay, I'll touch on this question first. I think firstly, you're right to point out that, like I mentioned earlier also, because last few years we have not seen their names in any of the GLS land bids. The only one I saw their name appearing was even when I saw their name appearing, I was very surprised also, because it was an EC site, and that's very not Hobby. They traditionally has been doing more upmarket properties. So I think one of the reasons they are also so holding back in recent years is also because of the stuck existing inventory that they have had. But if you look across the longer term, I think there has been hits and there has been misses. The first time they went into Sentosa, it was a hit. The first time they went into UK, it was a hit also. So it's only in recent, the last batch of the Sentosa properties that they went in was a miss. But I think in general, the reason, if you're asking for the reason why they're not so active in Singapore land sites, I think it's because of the existing inventory. But if you say venturing overseas means higher risk, higher and more uncertain returns, I think some of the overseas projects that they have ventured into are doing pretty okay. They have a joint venture with Yanlot for a Shanghai project. That one is selling very well. They have Zhuhai projects as well, Tangshan as well, is pretty okay. Their UK offices that they have bought, even though there's a bit of uncertainties over Brexit, but then I think there is quite a good security in that the leases are very long. One, you have your leases fixed on every 5 year. There's a rental review, so this rental review is upward only. So you are basically assured of your rent. So you are assured for 5 years, and then 5 years later you have a rental review where it's only upwards. So it's basically very, very stable income. And if talking about the GBP depreciation, then at least they are hedged on the natural hedging front, because they also take on loans in GBP. So I think in general, then if you look at Metropolis, right? Metropolis, there's another question on Metropolis for them. Worrying about the concentration risk for Metropolis, because like I said, by my estimate, I think about below 60%, maybe 56% of total rental income is coming from Metropolis, and that's really their star price asset. And I think firstly, if you look at Metropolis, it has to be said to be a big success, because the first time they went in there, it's grade A office in suburban area, nobody dared to go in. So when they finished this building in 2012-13, I understand that their construction cost was about total about 800 million. If you look at the valuation now, is already 1.8 billion. So they have the amount of gains they have had over these last few years is phenomenal. And I think it's just a function of how well that building is done. Since they have opened or started that building, it's been 100% leased. You have star names over there, oil and gas companies, Shell, SGX is there as well, PNG. I think it's that building, if you're worried about concentration risk, I think it is a pretty good property in a good location. Even the 30% leases expiring this year, I don't think there's much risk as well. And if you talk about concentration risk, I think different REITs also have different such concentration risk. If you look at FCT, right, Causeway Point also accounts for half their rents. But if that building is a star, if it's a star building, then somehow if you look at FCT, it's 50% from Causeway Point, and then you have North Point, which is just two MRT stations away. So you're actually really, maybe there's a risk of cannibalization as well, especially now that you are starting new North Point City, right? But if you are dominant, if that building is a dominant asset, is a strong asset, then I think the concern for concentration risks should not be that high. So to answer the question, I think Metropolis shouldn't be too much of a concern. And then there's another question on CCT about this Singapore government is taking back the land at Bugis Village, and that is going to happen in April next year. So what is the impact on this? I think there has been reports about that I think rightfully maybe there are concerns about this land being returned, in that because you see that the last valuation is about 44 million. And so I think maybe the presumption is that you have a property that was valued at 44 million 1 year ago, and then in April next year it will suddenly collapse to zero. But then if you look at the annual report, the purchase price for this Bugis Village, when they did the purchase in 2004, that was actually, the purchase price was only about 56 million. So number one, it has already been factored into the purchase price. You pay out 56 million 13 years ago. Every year you collect rents of about 10 million. And even if I factor in interest costs plus the compensation of 6.6 million at the end of the lease next year, I think you are looking at very, very decent IRRs. So because my point is, the low purchase price in 2004 actually means that your MPI yield on cost is actually very high. So that has actually, I think, has actually been factored into the cost. So if you look at it on a longer term basis, what they've done with this property, actually, I don't think there's too much of a concern. So, and in any case, it's going back to the government in April next year. They have compensation of 6.6 million plus interest. In our modeling, we have assumed that they will use the compensation for cash top up to offset any loss in income in next year, 2019. Hi, there's another question on CRCT on whether the retail mall dynamics in Singapore and in China, how different is the retail mall dynamics, and comparing Singapore retail to China, because if Singapore is not doing so great, then would it be different in China where online shopping is more prevalent? I think it is true. We are observing on the ground that Singapore in the malls, tenant sales actually is kind of lagging the general retail sales index. I think if you look at tenant composition across the malls in these two countries, I think they are pretty similar. We attended one of these talks by CMT CEO. There was a question for him on how different is the mix for tenants in these two malls. I think his comment was also that it's pretty similar, but I think in China maybe they have a little bit more departmental stores. Like departmental stores over there is still quite a mainstay, quite I think a bigger proportion in their malls. But I think from tenant sales from these two REITs, CRCT and the Singapore REITs, the China REITs, CRCT at least, the main Beijing malls, the tenant sales stabilizing in the mid single digits, they don't seem to be hit as hard. I think firstly also because in Singapore the dynamics this few years is a bit more different. These few years we have a lot of new startups trying to disrupt this space. We have startups in the segments which used to be deemed as like more resistant, the grocery segments. You have Redmart. Last year we have Amazon coming in. This year we have Alibaba investing another 2 billion in Lazada. So when all these new startups come in and try to disrupt the space, I think there's going to be a lot of promotions going on, a lot of throwing money to gain market share. When all this happens, I think there could be some migration to the online space, but I think in China it could be a little bit more mature, as you have correctly pointed out. So I think what I see now is that these tenant sales in China, they're actually more doing at least a little bit more better, a little bit better than Singapore's. Yeah, go ahead. Hi, another question on FCT's Bedok Point. Why are they unable to turn it around after such a long time? I think my feel is for mall to be successful, you have to have scale. If you're a tiny mall like Bedok Point and you're not near to transport nodes, then if you're tiny, that means that your variety or your range of offerings will not be able to be as wide. So when your variety is not able to be as wide, there's less reason for people to go to you as a destination shopping point in their leisure time. Especially now, so when Bedok Point's competitor Bedok Mall, firstly right next to the MRT and transport hub, the bus interchange, and also Bedok Point is bigger. So I think these are the reasons why I think Bedok Point has been unable to be turned around. And which office REITs are we most bullish on? I think I don't have coverage on Keppel, FCOT or the rest, but I think if you compare CCT Grade A versus Grade A Keppel, your Suntex, I think one of the more appealing things for CCT to me is that they have a bigger proportion of their portfolio which are on freehold or 999-year leases as compared to Keppel or Suntex. So these two REITs may be trading at about the same yield. I think Keppel and CCT, and CCT's price to book may be higher, than Keppel. Keppel may be trading at a discount, but I think it's fully justified. And I think if you look at CCT's occupancies over the years, it's been pretty solid, pretty stable, even through GFC years. So for S REIT in summary, I think if you can tell, our accumulates are mostly from commercial and industrial sectors. Hospitality, we have yet to commence coverage as of now. Okay, if there are no more questions, I think we'll call to an end our webinar for this week. Thanks for tuning in, and we see you guys next week.